First of all, those that might have been retired for quite some time, have no mortgage, but now are looking to get into a smaller home. What is one key takeaway that you would suggest to those people in terms of making sure that their financial position is strong moving forward if they need extra money? So what would be the difference between, say, a line of credit and a HELOC? Now, let's talk about the individual who is getting ready to retire. They've got the income right now, they have a house, and they are thinking about downsizing or right-sizing. What advice would you give to those individuals? Hello, and welcome to Realty Bytes, conversations on real estate and lifestyle. Now, if you're thinking about downsizing, whether you are looking to move to a smaller home, less payments, it's a change in life, maybe you're retiring, getting a divorce, the kids have left the nest, there's so many reasons to downsize or right-size, as we like to call it. Today we have mortgage specialist Kyle Cole from Bank of Montreal, who's going to talk to us about some of the financial aspects that we need to consider when downsizing or right-sizing. Good morning, Kyle, and welcome to the show.
Thank you, Evelyn. It's always a pleasure to be here.
So I'm sure as of late you've heard or been in contact with a lot of people who are looking to make life changes, one of which might be a downsize or a right-size move.
Yeah, absolutely. We see it all the time where it's time to move. Maybe move out of the GTA, move somewhere more either affordable, more comfortable, maybe getting ready for retirement, lifestyle changes. We see it all on a regular basis.
Okay, so there is lots of reasons why someone might downsize. So let's start with what comes to mind first, which is those individuals who are retired or getting ready to retire. And they're in this home that they've been in for many, many years. Maybe it's too large. Maybe there's too much maintenance. They don't need all that space. They want to free up some money. Let's start with those people. And let's go to, first of all, those that might have been retired for quite some time, have no mortgage, but now are looking to get into a smaller home. What is one key takeaway that you would suggest to those people in terms of making sure that their financial position is strong moving forward if they need extra money?
Of course. So by downsizing, you're essentially going to be taking out a lot of equity in your primary residence to purchase something much on the lower scale. So you should have a lot of savings. So of course, just making sure that your payments are at a very minimum, maybe paying out any debt that you have available, if you have any car loans, anything like that, just to make sure you limit the payments you have yourself. But on the other end, everyone, I believe, could use some sort of financing on their home, whether they are being charged, it may be interest or anything like that. That's where the line of credit comes into play, is having that access to the equity no matter what is always good. You never know when you're going to need it. It's one of those great things too, where it's a line of credit where you don't pay anything unless you actually use it. So emergency funds, it's there in case you ever do need it.
Right. And I think that's a really valuable point. What I find is a lot of people have grown up in a time period when it was like, oh my God, the first thing I need to do is pay off my mortgage and have no debts. And they feel that sometimes a line of credit is a debt. But to me, it isn't, for a couple of reasons. One is, as you said, it gives you access to equity if you need to have it for an emergency situation, or maybe even you want to do something extraordinary, like travel the world a little bit or something like that. But for a more practical purpose, I find a lot of times as we get older, maybe one partner needs to go into a retirement home, or there's some health issues that we need to deal with. And, they've gone to the smaller home. Maybe they have very minimal savings, and then this life event happens and they've got no money and really no income in a lot of cases in terms of retirement to qualify for anything. So having that line of credit available will give them access to funds when they need it, and they don't have to pay anything if they're not using it. And why don't we talk about if they are using it, what type of payment structure can there be on that line of credit?
That's the best part about it too, is the minimum payment is interest only payments. So of course we're in an environment right now where rates are at an all time. So payments right now could be a little on the higher end, but it is actually more comfortable than an actual mortgage payment. It's interest only. So as interest rates start to drop too, because every variable or every line of credit is a variable rate, payments will actually start to drop, becoming more and more affordable. So we can kind of look at maybe at the beginning of COVID when the Bank of Canada rate was 2.45, people were taking out equity left, right, and center to have access to a line of credit because the payment was very, very, very low. So hopefully we get back to those interest rates at some point. But you said it best. Honestly, line of credits, they're not a debt. It's an emergency fund. You have to be grounded enough to not use it unless you really, really need it in a way, and you have the means to pay it back. But it still gives you that access no matter what in case you ever need it. We've even seen a lot more creative ways too, where maybe retirees are downsizing, taking out a line of credit, and potentially even using that to help a grandkid for a down payment. So using it in all those creative ways, you never know when or if you are going to need it.
Okay, so what would be the difference between, say, a line of credit and a HELOC?
So a HELOC is a home equity line of credit, specifically secured against your property. So those are the ones that are interest only versus personal line of credits tend to be a lot smaller amounts. The interest rates are not based off of the prime rate close by. They're normally like in this environment sometimes 11-12% versus around prime rate for a HELOC, and the payment options are a lot more. So HELOCs are the interest only. Personal line of credits, they could range from like a 2% balance per month. So just say you have a $20,000 balance, you could be paying $400 versus a $20,000 HELOC. Your payment might only be like $60. So you can see the big difference there when it comes to affordability.
Right. So it would, I mean, every situation is different, but for the most part, it would be better to have a HELOC so it's registered against the property.
Correct. Yes, absolutely.
Right.
Better interest rates, you can get significantly more amounts.
Right. And the other thing, too, in having a HELOC registered against the property, it does make it a little bit more difficult for someone to do fraud and take your
Yeah.
property away because they've got to get rid of that registration with the bank, too. So,
Yeah.
not that we want it for that reason, but
I
there
know.
is that little extra bonus there as well.
Absolutely.
Okay. Now, let's talk about the individual who is getting ready to retire. They've got the income right now, they have a house, and they are thinking about downsizing or right sizing. What advice would you give to those individuals?
Yeah, and try to do everything before you officially retire. When you do have the income, you want to make sure that all of your finances are in order, whether that's getting the highest amount of a home equity line of credit available to you while you can qualify, paying out all your debts, making sure you're financially secure in order to take that next step for retirement. So kind of like the same similar situation as the first scenario we went through. If you do plan to move while still working, that might actually work even better in your favor, even if it's a couple months before you retire. That way you can get that high amount of a home equity line of credit on the new property specifically, maybe not have so much of a mortgage on the other end, or no mortgage at all. That way, still, same thing. You have that equity available to use for whatever you need to do. Like you mentioned, travel, gifts, paying for kids, grandkids, weddings. The opportunity is endless.
And just even the secure peace of mind to know that you've got this money if you need it. And that's a great piece of advice because I find a lot of people wait till after they're retired. And so now their income qualification goes from here to here.
Yes.
Like for those who can't see, it's from way up,
Yeah.
high to something very, very low. And if they had done it a couple of months before, potentially, they'd have a larger amount that they would have access to that they don't need, but it's there.
Yeah.
And as inflation changes too,
Mhm.
so what was a lot of money 100,000 years ago might not be so much, years from now, 10
Of
years from
course.
now, it might not be anything. So you want to get as much as you can because that line of credit doesn't rise with inflation,
Of
correct?
course, 100%. Trust me, we wish it did.
Hmm. Okay, so there's the downsizing for those two segments of the population. Now we have another segment of the population that might be downsizing because they're in a home that has become too big for them or it just no longer serves them because maybe they're going through a divorce or the kids have left the home but they're still young. Or what I'm seeing a lot of currently is their mortgages are coming due for renewal. They took out their mortgage during the pandemic when it was essentially free money. And now they have these changes in payments. So maybe you could talk a little bit about that
Of
scenario.
course. Yeah, and honestly, we've had a lot of clients come our way with that exact scenario where their kids have left, they have all this space, but they don't know what to do with it. And we, at least I have noticed that a lot of people are emotionally attached to that long time home. And that's the tricky part, is getting over that attachment to get to the next step to say, hey, is this feasible? Does this even make sense for me to still be here? It all depends on lifestyle. Everyone's situation, of course, is different, but sometimes it might even be the only option, where mortgages are coming up for renewal in a time where interest rates are very high, where 3 4 years ago interest rates were 4% less, call it, where now your mortgage payment is changing. So sometimes the only option is either to renew your mortgage and increase your payment by a lot and have to afford it that way. But some people can't afford it, and it is a harsh reality. So that's where the option is to downsize, to take a much smaller mortgage, take out that equity in your property that you've built for so long. Just kind of let go of that home, unfortunately. But it kind of gives them the option to be more financially secure in a smaller home.
Right. And so, if that was a situation that someone was coming up to, in terms of reaching out to a mortgage professional like yourself, when should they be doing that to see where the numbers are and what's going to transpire?
Of course, honestly, right away, because what we do is run through hypothetical scenarios just on paper. We don't have to jump right into an application or anything like that. Mortgage applications are all numbers based, and I love personally working with numbers. So I can actually give someone a good estimate in terms of how much equity that they have, what mortgage payment would they be approved for in the future, kind of cleaning up all their debts and understanding their situation. We can just run through everything on paper and get them a really, really good estimate to see what their qualification would be by selling and downsizing into a new home.
And right. And also what their new payments would look like, right?
Absolutely.
Because they're saying, okay, I know I'm going to get this new rate. What are those new payments? And then they can decide whether they feel comfortable with that or whether that's going to put them in a situation that they feel like a little strangled, right?
Yeah.
That they're really under a lot of stress. And we don't need more stress in our lives. So I think knowing your options up front would make it much simpler.
Mm.
So if they were going to, first of all, let's say they're going to stay with the mortgage and now there's a higher rate that's coming into play, do they need to requalify for that mortgage or how does that work?
It depends on the situation. So when you go and get approved for a mortgage at the very, very beginning, the bank is actually approving you based off of, call it, the full 30 years. So just say your first 5 year term is up. If you want to renew and just keep your same mortgage as is, you actually just need to sign. You don't have to requalify. However, that's where the conversation comes into play, is now you have 25 years left on your mortgage. You have to now pay off your mortgage in the next 25 years. And depending on your interest rate situation, maybe you took variable and your payment was still low, but a lot of balance has been increasing on your mortgage. You want to kind of understand your situation as a high level. So when it comes to the requalification, that's only if you refinance. Whether you want to take out equity of your property, you want to re-amortize over the 30-year time frame again, that's the situation where you would have to requalify. So same thing, everyone's situation is a case by case. What I always recommend is to get in front of us as soon as possible, just to kind of understand your situation, see what makes sense. Sometimes it might make sense to just renew and keep going. Maybe you can't actually requalify. Or if you have a lot of debts and a lot of monthly payments, to requalify, refinance, group everything all in one, and kind of start fresh at the full 30-year mark. So it's a case by case
Okay.
basis.
Okay, so just as a quick synopsis, if you're staying with the same lender, you're staying with the same mortgage, you're just getting a new rate, you don't have to qualify for that higher new rate. If you're making any changes to your mortgage whatsoever, you're going to need to totally requalify, which may mean you may not requalify. You might not qualify for the new mortgage. So it is really important that people speak to their lender and find out what their options are, because what you think you might be okay with might not be the case, not only in qualification but in actual um, being able to pay and make those payments.
Absolutely.
Okay.
I'm really big on monthly budgets just to make sure and understand what is your budget at, what can you afford. Ultimately, all of this is about affordability and making sure that payments can and will be made.
Okay. So now let's take the situation where somebody looks at those payments that you've given them and they're saying like, oh, this is like just too much, right? I was before at 1.8 and now I'm at 5 and like my payments are 2.5 times more. I can't afford this. I'm going to sell my property. I'm going to take what equity I have and I'm going to downsize into something smaller. So this is where it becomes a little bit more tricky, because depending when you purchased your home, we have to see what you purchased it for and what is the value today, right? Some people, unfortunately, bought at the very height of the market. And so they may have actually purchased more for their home than what it's worth today. And that's a whole different scenario. So in that case, I guess first thing they have to be able to do is to be able to pay off the mortgage balance, right?
Absolutely, 100%. So, based off of the mortgage balance you had versus the sale price or expected sale price, minus any fees, penalties, anything like that that you have to consider, you want to make sure that you can 100% take or get rid of that mortgage specifically. It's just running the numbers.
What happens to an individual who is going to be in the minus?
That becomes really tricky. So their first option is, of course, to stay in the property and to just keep paying the mortgage. The second option is if they do have outside savings to make up the difference, then they can technically pay it off and essentially get rid of the mortgage. The third situation is out of my realm, unfortunately, where that would be speak to a lawyer. How that all works, I'm not 100% sure, to be honest.
Mm-hmm.
That's where, foreclosure and all that, but not my expertise, unfortunately.
Okay. So then let's take a situation where someone wants to avoid all that. They've got enough to at least clear their debts and to go sell the property, pay off the line of or the mortgage, and then now they've got a little bit of money left over. And they want to ideally stay in the market, right? So how does that work? And they want to buy something new.
Of course. So it's kind of like just purchasing another property in that case. You sell your property, you take out X amount of equity, just say it ends up being $200,000. Now that $200,000 now becomes your down payment for your new purchase. So if you're in maybe a property within the GTA that you had an extremely high mortgage, you took out 200,000, maybe look to move a little bit outside where you can afford. So that's where the qualifications, it kind of really starts off fresh. We look at your down payment of 200,000, we compare it to your income, and we kind of requalify you for another purchase.
Right. And so that's where they need to go back and look at the numbers, because sometimes they were like, well, when I bought that house, I was qualified for $1,500,000. And now they think they're still qualified for the $1,500,000, but the numbers really will give them a whole new range at what they should be looking at, correct?
Yeah, qualifying rates have gone up. So it is definitely more challenging to get approved overall. But that's where same thing. It's all about free advice, and we can run through numbers and get you a pretty good estimate on the qualification on how much you would be able to be approved for.
Right. And the best, I guess, scenario is if they're looking to get out of their mortgage and decrease their mortgage or pay it off and go from owning to renting or whatever they want to do, is to do it at the time that the mortgage becomes due, correct?
For the most part, yes. However, some institutions, BMO included, we actually have the option to port your mortgage. So think about it as you're literally just picking up your mortgage and placing it on another property. Yes, the amounts are going to be a lot less, but that's where we can kind of run through the numbers and understand the prepayments too. Because with most BMO mortgage, you can actually prepay 20% of your original mortgage balance per calendar year. So it's all about pre-planning too. So just say you have a $500,000 mortgage, and now you only need a $400,000 mortgage. That extra 100,000, once the sale takes place and you take out that extra equity, you can actually put that right back onto your existing mortgage without any penalties. Now, the whole idea of porting your mortgage as is to avoid any penalties. So if you're not within your renewal period, just pick up your same mortgage and just plop it down on that new property. But in a short answer, yes, if you are coming up for renewal and you want to explore this option, that is technically the best time because there won't be any penalties to get out of your existing mortgage term.
Okay. Now, if you're going to port your mortgage and you need a lesser mortgage, you don't want to pay a penalty on that mortgage, you're saying you could use your prepayment privilege to pay down so that you don't have to pay for paying that money off in advance. But if you port that mortgage, are you not taking the mortgage as is, which includes the interest rate that you're at?
That is correct. Yes, you're taking your exact same terms, interest rate, current remaining left in your existing term, your current amortization or life of the mortgage, and just placing it on that new property. That's correct.
Okay. So in that case, if someone's trying to lower their payments, one is to go to a smaller property and have less of a mortgage, but you're still paying those higher payments, or they could choose to discharge that mortgage, reapply and get a new mortgage at a lower rate. So again, that's where you can run the numbers for them and tell them which would be to their advantage. Would it be better to pay the penalty? Or would it be better to just take the mortgage with them and just decrease it in a new property, correct?
Yeah. So one thing that we do though is think about the first scenario where they sell, they do have a lesser mortgage by putting a big lump sum on. We can actually re-amortize that mortgage and reduce your payments. The way the bank looks at it is you're making a lump sum in that situation. You're making a lump sum of $100,000 onto that mortgage. So you've actually prepaid your mortgage off quite a bit. So we will actually allow you, specifically Bank of Montreal, to reduce your payments now to re-amortize back to your original contract, which ultimately reduces your mortgage balance and it reduces your payment. So it gives them the best of both worlds.
Right. So there are the most important takeaway is there are options, right? So don't feel like you're just totally against the wall. Speak to someone like yourself and find out what those options are and see what makes the best sense, right?
It's all about options in this environment. Everyone just wants
Mm-hmm.
options. Sometimes it might be the best option financially. Sometimes it might look worse that way, but it might be the actual best option for yourself. Options are what people want.
Right. And the comfort. You want to feel comfortable in where you are at any point in your life. So sometimes, like you said, we're emotionally attached to something, but it really is in our best interest to make a move. And that's downsizing, but it's also sometimes upsizing. You've got all these extra kids and you're in this little space, right? It's better that they have their own room.
Yeah, absolutely. Absolutely.
Right. So any last minute thoughts or advice for our listeners?
Honestly, it's free advice. Feel free to reach out at any time. I'm always more than happy to just answer any questions for yourself, help come up with a solution, and to provide any option available to you.
Okay. And what's the best way that we can reach out to you, Kyle?
Yeah, you can either call me, text me directly at 647-331-8850, or even email me at kyle.cole@bmo.com.
And that's Cole, C-O-L-E, correct?
Correct, yes.
So kyle.cole@bmo.com.
Correct, yes.
Okay, great. And thank you so much again for dropping in and sharing all of your great insight. You've been with us a couple of times, and it's always very insightful. So I really appreciate your time.
Always a pleasure. Thank you, Evelyn.
Okay, thanks, Kyle.